Credit risk in the United States today is at the lowest level since 2007. Now, that may sound like a good thing, but seeing credit risk go down like it is today has often been a sign that financial markets are too complacent. We saw this in 1998, right before the Asian financial crisis, and then the 2001 recession. We saw it in 2007, right before the beginning of the Great Recession, and we have multiple other examples of low credit risk eventually being followed by periods of elevated financial stress. It's often said that when the market is getting too complacent, that's when investors should be looking in the other direction. Many surveys are showing that consumers have gotten very optimistic on the stock market more recently. This survey from the Conference Board is showing that the average person has rarely been this optimistic about the stock market over the last 30 years. So is this extreme optimism a big warning signal for investors? One of the best indicators that we use to measure the complacency of the market is this chart right here. This is the volatility index of the S&P 500. And typically when volatility is very elevated, like in these instances right here, it's a pretty attractive moment to actually be buying the stock market, because elevated levels of volatility only really occur when there's a lot of fear in the market. The VIX is essentially the expectation of future S&P 500 volatility based on the options market. And so the higher the VIX is, the more that means traders are hedging against downside on the S&P 500, meaning that there's a lot of fear. Now, when we zoom in on the VIX today, it is trading at the lowest levels in over 4 years. That means investors are more complacent about future market volatility than at any other moment over the last 4 years. Now, when we look at other moments when the VIX was particularly low, like in these instances right here, well, in many of these cases, it wasn't such a great idea to be investing in stocks. In 2007, the low volatility marked the moment where the stock market was making its peak before a 60% drawdown. In 2014, this low volatility reading led to the market going sideways for 2 years. In 2017, this historically low VIX reading was followed by 3 years of market consolidation. Now, today, while the VIX is low relative to anything that we've seen over the last 4 years, it's not historically low like in these instances right here. In fact, throughout history, the VIX has often found itself trading in this exact range for multiple years at a time, which coincided with periods where the stock market was actually performing incredibly well. So extremely low volatility is a bad thing for the market because it signals that the market is being too complacent. But reasonably low levels of volatility can actually be a pretty good thing, and that's where we find ourselves today. When we take a look at the most recent developments on the VIX, we see that since about December of 2023, we've seen the volatility of the S&P 500 rise. In fact, it spiked right here in April as the market dropped by around 6%. But since then, volatility has come back down quite aggressively, returning to these very reasonable levels. One of the big driving factors behind the market's volatility today is simply the price of oil. You can see ever since the beginning of 2022, we've seen oil prices and the market's volatility have traded very closely to one another. When oil prices have been rising, volatility has been rising along with it, and when oil prices have been coming back down, volatility has also been coming back down along with it. This relationship was telling us to cut our exposure in September of 2023 and in March of 2024. These were moments when volatility was low, but oil was telling us that wasn't going to last. And in April, we had the exact opposite, where volatility spiked, but oil prices were coming back down, telling us that we could increase our exposure to the stock market. Today, oil that's moving lower isn't telling us that we should be worried about increasing volatility. Quite the contrary. For now, it's telling us that spikes in volatility should be used as opportunities to buy the dip on the stock market. We track these developments almost every day with our members at Game of Trades. We take you through financial markets step by step. If you want to level up your trading game, come and join our amazing community. By the way, we are hiring at our creative studio, Bravos, where we produce videos for various platforms. We're looking for someone to do voiceovers, someone who can speak in a video from a script. All you need is a confident, clear, and excited voice. This is a remote part-time job. Click on the link in the description and send us a trial recording of one of our videos with your voice. I look forward to seeing it and potentially working with you.